Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine IPSAS 13, Leases, using question 1 of ICAN November 2024, Public Sector Accounting and Finance as worked example. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. What is a lease? A lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration known as rent. A contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration known as the rent. In a lease contract, the lessor parts with the possession of the asset in exchange for rent. Parties to lease. Basically, there are two parties to lease. There are two parties to a lease contract. Number one is the lessor. The lessor is the owner of the lease asset. The person who conveys the property, the asset, to the other party for use is known as the lessor. It means the lessor expects in return a payment known as rent for giving the lessee the right to use the underlying asset. So, lessee, the person to whom the right is given to make use of the underlying asset is known as the lessee. Right is given to the lessee to make use of the underlying asset and make a periodic payment to the lessor. That payment is known as the rent. So the lease agreement, the agreement between the lessor and the lessee, is a form of landlord and tenant relationship. You know, landlord will give the tenant the premises to use, and the tenant will make use of the premises and pay the landlord in return a periodic payment known as the rent. So that is the lease contract. Types of lease. Types of lease. There are two types of lease. Number one, we have the finance lease. Finance lease or capital lease. Capital lease. The second one is operating lease. Operating lease. What is a finance lease? A finance lease is a long-term, non-cancelable lease agreement. It's a long-term lease agreement, non-cancelable lease agreement. That means it's a long-term lease that cannot be cancelled. A long-term, non-cancelable lease agreement. A long-term, non-cancelable lease agreement in which the risk, reward, or benefit of ownership is transferred to the lessee. So it means in a finance lease, I've told you that it's a long-term lease, long-term, non-cancelable lease agreement, non-cancelable lease agreement in which the risk and reward of ownership is transferred to the lessee. It means when the risk and reward of ownership is transferred to the lessee will be able to exercise the full control over the asset. The asset will be in the possession of the lease or of the lessee. Lessee will be the form of the full owner. We exercise the full control as the owner of the lease asset. That is finance lease. So, what are the features of finance lease? In the definition I have outlined, you'll be able to identify some of the features of the finance lease. We say it's a long-term lease agreement, and then it cannot be cancelled. We said the risk reward of ownership, we say, is transferred to the lessee. So that means if risk is transferred to the lessee, the insurance and maintenance of the lease asset will rest on the lessee. The lessee will be the one that will insure and maintain the lease asset. Operating lease. This is the opposite of finance lease. So if finance lease is a long-term lease agreement, that's to show that operating lease is a short-term lease agreement. We say finance lease is not cancelable. That means operating lease can be cancelled. We said in the case of finance lease, we said the risk and reward of ownership, we said it's transferred to the lessee. That means the lessor is the one that will bear the risk and reward of ownership. So it is not transferred in the case of operating lease. It's still rested on the lessor. So these are some of the features, but I will examine the operating lease in another video. That is why I won't say anything beyond this. So in this video, I will focus on the finance lease. Differences between finance lease and operating lease. Differences between the finance lease and operating lease. Number one, if you go by the definition I've given to you, we say finance lease is a long-term lease. So finance lease is a long-term lease agreement, while operating lease is a short-term lease agreement. Number two, we say finance lease cannot be cancelled. That is why we use the word non-cancelable in the definition, while operating lease can be cancelled. Number three, from that same definition, we said the ownership is transferred to the lessee. We said the risk and reward of ownership, we said they are transferred. The risk and reward of ownership are transferred to the lessee. But in the case of the operating lease, the risk and reward of ownership are not transferred to the lessee. Number four, we said the lease term form the major part of the economic life of the asset. The lease term form the major part of the economic life of the asset. If the economic life is if it is 10 years, the lease term should be 8 or 9 years or 10. It should be close. So if you are having a wider margin, if the economic life is 10 years and you are having the lease term to be 4 years, it is not a finance lease. No, that type of lease is an operating lease. So the lease term form the major economic life, major part of the economic life of the asset. Then number five, the present value of the lease asset must amount substantially to asset value. The present value, by the time you calculate the present value, we will still discuss this later. By the time you calculate the present value of the lease term, of the lease asset, it must be very close, if not exactly the same. It must be close to the value of the asset. If the lease term, if the value of the asset, if it is 20 million, by the time you calculate the present value of the lease, you must have close to 20 million, maybe 90 million or close. But if you are having the value of the asset to be 20 million, and by the time you calculate the present value and you're not having like 10 million, that type of lease is not a finance lease. So the lease term, the present value of the lease asset must be amount substantially to asset value. But in the case of an operating lease, the present value of the lease asset may not amount substantially to asset value. Then the last one, the finance lease is a statement of financial position event. It's a balance sheet event. It's a statement of financial position event. So that is why you will have finance lease in statement of financial position as an asset, a non-current asset. But operating lease is no statement of financial position events. It's non-balance sheet event. So operating lease, you will not have it as an asset in the statement of financial position. In the books of the lessee. So we want to look at the steps for solving IPSAS 13. Steps for solving IPSAS 13, lease in the books of the lessee. The first step is to identify the type of lease involved. Identify the type of lease involved. So the first thing you should know, if the lease in question is a finance lease or operating lease, because the steps or the procedures for solving questions involving operating lease is different from that of finance lease. But in this video, I want to focus on the finance lease. So operating lease will be examined in a separate video. So for a finance lease, where the lease involved has been identified to be a finance lease, the first thing you will do is the measurement of lease. Measurement of the lease. By measurement of lease, we mean the determination of the monetary amounts that will be recognized in the financial statement. So upon initial measurement, we normally measure two things. There are two things we normally measure at the inception of the lease. The first one is lease liability. Lease liability. And the second one is lease assets. These are the first two things that will be measured on initial measurement. Remember, I'm looking at initial measurement. That is, if you want to measure the lease for the first time, the entity does not have lease before, but they are entering into the lease contract. They are entering the lease contract for the first time. So you know that you will recognize an asset in the book of the lessee, in the book of the lessee. Then you will equally recognize a liability. Those are the two things that will be recognized for the first time. So, but at the initial, the very first day that they are entering into a lease contract, I've told you, you must measure the lease liability and the lease asset. What is the lease liability? So, to calculate the lease liability is the present value present value of the lease payments that are yet to be made. The present value of the lease payments that are yet to be made. The present value of the future lease payments, that is the initial value of the lease liability. So you calculate the initial value. This initial value, that is, you calculate the present value, you have to compare the present value with the fair value of the lease. Fair value. Whichever one is the lower will be used. The lower, the fair value may be given in the question, in your exam questions. The fair value may be given. So what you need to calculate is the present value. Remember to calculate the present value. I've told you the future lease payments, the payments that will be made in the future, not those ones that have already been made in the past. You know, if you want to calculate present value, we usually discount the future cash flows. So the future cash flows are the future lease payments in this case. You'll be given the discount factor, the cost of capital. So the discount factor will be applied in discounting the payments that will be made in the future. And when you get the present value, then you compare it with the fair value. Whichever one you have, the lower of the two, will be used. So that is the initial value of the lease liability. Now, you've obtained the initial value of the lease liability. The second thing you need to determine is, you've gotten this lease liability, which is the initial value, which is the present value of the future lease payment. I've told you have to compare with the fair value. You go for the lower. Then, after that, the next thing is the lease asset. Lease asset. To obtain the lease asset, the first thing you do is to take the initial measurement of the lease liability. Lease asset, which is right of use asset. So, lease asset, also known as the right of use asset. You've gotten the initial value of the lease liability, which is the present value. So you take that. That is initial measurement of lease liability. The value obtained here from A, that should be the starting point. Then you add, if any, initial direct cost. If any, you add initial direct cost. Then, if any, lease payments made before the commencement date. Commencement date. Less any incentives received. If there are incentives received, those incentives, you have to subtract that. Then, if you have cost of removing or dismantling, let me say cost of dismantling or removing the asset. The sum of all this will give you the initial value of the right of use asset. That is the initial value of the lease asset. Please take note of this. You've gotten the initial value. What are the accounting entries you need to make here? The accounting entries is to debit the asset. Accounting entries for recording this, accounting entries for recording the initial value is to debit the lease asset. Asset will have a debit balance, and credit the lease liability. That is the entries required or needed in the book of the lessee to record the value of the assets and liabilities upon initial recognition and measurement. Step 3, subsequent remeasurement. By subsequent measurement or subsequent remeasurement, we mean how you determine the value that will be recognized in the financial statement at the year end of the entity, at the balance sheet date, at the statement of financial position date. The value that will be recorded, the value that will be recognized in the statement of financial position, the one that will be recognized in the statement of profit or loss, how you determine them. That is what we mean by the subsequent remeasurement. So the number one thing that will be recognized is finance charge or lease interest. Finance charge or lease interest. You want to determine how much will be the interest that will be charged. Remember, the interest expense in the period will be recorded in the statement of profit or loss as finance costs. So now you want to determine the finance charge. Total is lease rental over the lease period. If the lease term is 6 years times annual rental. If the rental is payable annually, so if suppose you have, let me just use N, number of renters times annual rental. My assumption is that the rental here is payable annually. So this will give you the total rental. Then from this, you less lower of fair value. Remember, I've told you the lower of fair value or present value will be used the other time. Present value. You go for the lower of the two. So the net difference will give you the finance charge. Finance charge. This will give you the total finance charge. So recognition of finance charge. Number 2, recognition of finance charge. The finance charge that will be recognized in the financial statement or that will be recognized in the statement of profit or loss can be measured in 3 ways. Number one way of measuring that finance charge is straight line method. Line method. This method is the easiest method to use under exam condition, and it is the commonest one. Remember, I've told you we have 3 methods, but the easiest one to use is the straight line method, where the examiner is silent. They are not being particular, where the examiner are not particular on the method to use. So you go for straight line method. But where other methods are required, you must follow the examiner instructions. So straight line method, your annual finance charge, annual finance charge, that is the interest. I've told you this method, the finance charge will be spread evenly over the lease period. You spread the finance charge equally. Same amount will be charged in each of the years. You spread it evenly over the lease term or over the lease period. So to get the annual finance charge, you have the total finance charge, total finance total finance charge or total lease interest divided by n, divided by n, where n is the lease term. N is the lease term. N is the lease period. So this will give you the finance charge that will be expensed in the statement of profit or loss. The second method is sum of the digits method. So under this method, finance charge or finance charge will be apportioned over the lease term by using the sum of the years digits. For instance, if you have 5 years, or let me assume you have 3 years. Yes, year 1, year 2, year 3. So you have to reverse the digit. Reverse the digit. If you reverse the digit, remember you have year 1, year 2, year 3. If you reverse the digits, that means you will start from 3, 2, and 1. If you have 4 years, 4 year 1, 2, 3, 1, 2, 3, 4. If you reverse this 4 years digit, then that means you will start from 4, 3, 2, and 1 in that order. If it is 5 years, you start from 5 till you get to 1. So the sum of the digits will be 3 plus 2, that is 5, plus 1, 6. Sum of the digit is 6. Now, apportionment of finance charge. Apportionment of finance charge. That is, you want to apportion the lease interest over the lease term. So the first year, you have 3 over 6 times finance charge. So that will give you the amount that will be charged in year 1. Year 2, 2 over 6 times finance charge. The total finance charge you have calculated. Finance charge, you can add total to it. Total finance charge. Total finance charge. While for the third year, you have 1 over 6 times total finance charge. So this is how to apportion the finance charge using the sum of the digits method. The third method of spreading the finance charge over the lease term is actuarial method. Actuarial method. Under this method, the finance charge is calculated on the outstanding cash portion, or is calculated on the outstanding element. Those ones that have not been paid over the lease period, the installments that have not been paid of the cash element, then you calculate your finance charge on that. Now, to calculate the finance charge under this method, it depends on whether the installment is or are payable in arrears or whether they are payable in advance. Where the installments are payable in arrears, installments are payable in arrears. Payment of installment in arrears mean the some installments are payable at the end of each of the period, end of the year. Where the installments are payable at the end of the year, you know it is payable in arrears. So to calculate the finance charge, you have year, you have opening balance, then you have finance charge or finance cost, anyone you like. Then lease payment. Then you have the closing balance. So you apply this table. Then the interest rate implicit in the lease will be given in the question. The rate of interest given in the question will be used to calculate your finance charge here. You have year 1, year 2, year 3, depending on the number of years involved to earn. So this is the format for calculating the finance charge using actuarial method where the installments are payable in arrears. 2, where installments are payable in advance. Payments of installments in advance mean the lease renter are payable at the beginning of each of the periods. The lease renter are payable at the beginning of the year, not at the end. So where the payments are made at the beginning of the year, you know it is payable in advance. So the table will appear just, you have year, then you have the opening balance. Then you now have lease payments. Then you have principal elements. The principal element will be obtained when you subtract the lease payments from the opening balance. It is on the principal element that the finance charge will be calculated. Finance charge. Then you have the closing balance. So you make use of this table where the installments are payable in advance. But if it is payable in arrears, then that means you are calculating your finance charge on the opening balances. But this one, your finance charge will be calculated on the opening balances. Then, step number, the last one is calculation of right of use asset, that is the lease asset. Subsequent measurement of lease asset. Subsequent measurement of lease assets. So, you know, initially it has been measured at cost. This cost is upon initial measurement. You now charge accumulated depreciation. Accumulated depreciation, you deduct it, if any, then to arrive at the carrying amount. It is the carrying amount that will of the lease asset that will be recognized in the statement of financial position. There are 2 methods of accounting for lease in the book of the Lessee. Number 1 method is where finance charge is recorded and held in suspense account. Number 1 method, methods of accounting for lease in the books of the Lessee. In the books of the Lessee. Number 1 method is where finance charge, where total finance charge, are held in suspense account at the inception of the lease. Where total finance charge are held in suspense account at the inception of the lease. Under this method, the following accounts shall be required. Number one, we have finance charge, we have lease asset account. Lease asset account. Number two, lessor account. Lessor account or lease liability account. Number three, we have finance charge suspense account. Finance charge suspense account. Number four, we have finance charge account. Finance charge account. Number five, we have accumulated depreciation account. Accumulated depreciation accounts. These are the accounts that will be opened where total finance charge are held in suspense account at the inception of the lease. And the second method is where the lease finance charge are recognized piecemeal, where the lease finance charge are recorded piecemeal as the lease renters are paid. So where the lease finance charge are recorded piecemeal as the lease renters are paid. In this video, I will examine the first method. I will leave the second method for another video. Accounting entries in the books of the lessee, where finance charge, where total finance charge are held in suspense. Where total finance charge are held in suspense accounts. So, number one, at the inception of the lease, at the inception of the lease, that is, at the commencement of the lease, when the lease happened for the first time, when the entity is recognizing lease for the first time. So when the entity is entering into the lease contract for the first time, I've told you, you will need to recognize the lease asset and the lease liability. So you debit the lease asset or right of use asset with the lower of the present value, with the lower of the present value of the minimum lease payment, and its fair value. So the lower of these two will be used. The lower of the present value of the minimum lease payment and the fair value or its fair value will be used. You also debit finance charge suspense account. Debit finance charge suspense account with the total finance charge for the period. Total finance charge for the lease period. The whole of the finance charge over the lease period is what will be debited to the finance charge suspense account. You also credit the lessor account or lease liability. The lessor account is the same as the lease liability account, with the total lease payment expected from the lease, with the total payment expected from the lease. Remember, the payments or the total payments expected from the lease will comprises the lower of the present value of the minimum lease payment or its fair value and the finance charge. So it means the sum of what of these two is what will be credited here. The lease asset and the total finance charge expected over the lease period. Addition of the two will give you what will be credited here. Please take note of that. Number two, payments of instrumental lease rental. Payments of the instrumental lease rentals. So the lease renter, when it is to be paid, remember the lessee is expected to make a periodic payment to the lessor. So the money will go out of the cash book of the lessee. The money goes out of the bank. The lessee's bank account will pay the money. So you credit the bank account of the lessee, and the money goes to the lessor. The lessor becomes the receiver. Therefore, you debit the lessor account. So debit lessor account. I've told you another word for lessor account is lease liability account. Debit the lessor or the lease liability account and credit the lessee bank account or cash account with the amount paid. With the amount paid. The amount paid is what will be debited to the lessor account and credited to the lessee bank account. Number three, recognition of finance charge. Recognition of finance charge. So you want to recognize the finance charge for the period. I've told you this can be measured in three ways, either by using the straight line method, or by using the sum of the digits method, and by using the actuarial method. I've recommended the use of the straight line method. I told you the straight line method is easier to use than other methods. So where the examiner is silent, I said you should always use the straight line method. So in this case, recognition of finance charge for the period. In that case, you debit finance charge account, you credit finance charge suspense. Remember, finance charge suspense has been debited earlier. So you credit finance charge suspense account. I've told you the finance charge suspense account have been debited with the total finance charge at the inception of the lease, at the commencement of the lease. The total finance charge was debited, but the amount meant for that current accounting period is what will be transferred from the finance charge suspense account to finance charge account. So in that case, you debit the finance charge account, you credit the finance charge suspense account. So it means what you have in the finance charge account is what will be transferred to the statement of profit or loss. So it is what you have in the finance charge that will go to the statement of profit or loss. But the total finance charge, that is the finance charge suspense account, will contain the whole of the finance charge for the lease period. That is at the inception. That is the accounting entry number 1, Roman figure 1. So the whole amount of the finance charge for the entire lease period is what was debited there. But from it now, you will now be making a periodic transfer from the finance charge suspense account to the statement of profit or loss. So that is why we are crediting the finance charge suspense account with the amount of the interest for the current period. You now debit the finance charge. If you don't want to debit the finance charge, you can say debit the statement of profit or loss. Then, with the finance charge for the current accounting period or year. So that is all about that. Number 4, depreciation will be recognized at the year end. So with the amount of the depreciation recognized, let me say at the year end, 1, recognition of depreciation for the year. For the year. So the depreciation for the year, you debit the income statement. Debit income statement. That is the statement of profit or loss. You debit the statement of profit or loss, and you credit the accumulated depreciation. With the depreciation charge for the year. With the depreciation charge in the year. So, B, the finance charge account will need to be closed. To close it, it means you close it to the statement of profit or loss. You transfer the balance in the finance charge account to the statement of profit or loss. You debit the statement of profit or loss, and you credit the finance charge, which has been debited, in order to close it. Finance charge account with the, let me say, on closing the finance charge. On closing the finance charge accounts. So these are the double entry required in the book of the Lessee, where interest are held in suspense. These are the accounting entries required in the book of the Lessee, where total finance charge are held in suspense account. ICAN November 2024, Public Sector Accounting and Finance question number 1. Following the directive of the Minister of Health to the Medical Research Council, MRC, to relocate its storage facility to the Federal Capital Territory, the director signed an agreement with Captain Nigeria Limited to lease its medical cooling system for a 6-year term, beginning from January 1, 2020, at the rate of 4.85 million naira per annum payable at the end of each year. The terms of the agreement shows that the medical cooling system has an estimated economic life of 6 years, and the facility will have no scrap value by the end of the year 4. The following additional information was made available by the Director of Accounts. The first asterisk, the lessor entity sets the annual rental to ensure a rate of return on its investment at 12%. The second asterisk, the fair value of the medical cooling system is 22 million naira. The third asterisk, it is the practice of the entity to use straight line depreciation for assets of similar type. The fourth asterisk, the medical cooling system reverts to the lessor, and there are no option of renewal. Required: 1. Prepare the journal entries in the books of the lessor and the lessee at the inception of the lease. 2. Justify the choice of the lease based on IPSAS 13 leases. Now, solution to the question. The lessee is Medical Cooling Medical Research Council, MRC. Medical Research Council. I've told you the first step is to identify the type of lease involved. If you look at the lease period, they signed an agreement with Capital Nigeria Limited to lease its medical cooling system for a 6-year time, beginning from January 1, 2020, at the rate of 4.85 million per annum, payable at the end of each year. So the lease term is a period of 6 years, and the economic life of the asset, the medical cooling system has an estimated economic life of 6 years. The economic life is also 6 years. So that's to show that this type of lease, since the lease term and the economic life are the same, this lease is a finance lease. Now that we have identified the type of lease involved to be a finance lease, the first step is to calculate the present value of the minimum lease payment. Calculation of the present value of minimum lease payment. Lease payment. Now, we used to have year, then the cash flows. Now, back to the question. You were told the director signed an agreement with Capital Nigeria Limited to lease its medical cooling system for a 6-year time. So the lease term is a period of 6 years, beginning from 1st of January 2020, at the rate of 4.85 million per annum, payable at the end of each year. So the lease term is 6 years. Then that means you have the annual cash flows for year 1 to 6 to be 4.85 million. 4.85 million, which is 4,850,000. Then the discount factor. The lessor entity sets the annual rental to ensure a rate of return on its investment at 12%. So the discount factor is 12%. So that means you are going to discount the cash flows using 12% cost of capital. Now, if the discount factor is 12%, remember these years were grouped. We have year 1 to 6. So anytime you have a constant cash flows, if you have constant cash inflows, and the time is grouped this way, that is year 1 to 6, then you are expected to make use of the annuity formula, which is 1 minus 1 plus r raised to power minus n over r. No, our r is 12%, which 12%, 12 divided by 100, that will be 0.12 plus 1, that will be 1.12. So we have 1 minus, open bracket, no, this is 0.12 plus 1, that is 1.12 raised to power minus n, and n is 6 years, over r, which is 0.12. So what is the cumulative discount factors for the year 1 to 6? So we have 1.12 raised to power minus 6. If you take it away from 1, divided by 0.12. So you have 4.111. 4.111. So the cumulative discount factor is 4.111 at 12% cost of capital. So if you have 4.111, so what will be the present value of that? So 4.111 times 4,850,000. The product of this and this, if you multiply them. So we have 19,938,350. This is the present value of the minimum lease payment. If you don't want to solve it like this, you can also solve it using this alternative way. Alternative method. So you have year, you have cash flows. Year 1, know the cash flow is 4,850,000. Year 2, 4,850,000. Year 3, 4,850,000. Year 4, 4,850,000. Year 5, 4,850,000. Year 6, 4,850,000. That is the cash flows. The discount factor at 12% cost of capital. Remember, the cost of capital is 12%. What is the discount factor? So the appropriate formula to use is 1 plus r raised to power minus n. So this is given year by year. So to make use of this. So you don't need to, you make use of compound interest formula. You don't need to make use of the earlier annuity formula used in solving the first one. So what is discount factor in year 1? So we have 0.893. Year 2, 0.797. Take R to be 12%. That will be 1.12 raised to power. No, this will be 1.12 raised to power minus n. So for year 1, you take your n to be 1. For year 2, you take n to be 2. Year 3, you take n to be 3. So in that order. So year 3, you have 0.712. In year 4, you have 0.636. In year 5, you have 0.567. In year 6, you have 0.506. So what is the present value? The present value will be cash flows times discount factor. 4,850,000 times 0.893. That gives us 4,331,050. For year 2, 4,850,000 times 0.797. That gives us 3,865,450. For year 4 and for year 3, 4,850,000 times 0.712. That gives us 3,453,200. For year 4, we have 4,850,000 times 0.636. That gives us 3,084,600. For year 5, 4,850,000 times 4,850,000 times 0.567. That gives us 2,749,950. And for year 6, we have 4,850,000 times 0.506. That gives us 2,454,100. Now let's sum up this. What is the total of the present value? 2,454,100 plus 2,749,950. 749,950 plus 3,084,600 plus 3,453,200 plus 3,865,450 plus 4,331,050. So we have 19,938,350. You can see that the present value under both methods are the same. You can only have a rounding up difference in your solution, but in this case, you have same value. So whichever method you use under exam condition are acceptable. Now we have calculated the present value of the minimum lease payment. How much is the cash price? Now, if you look at the question, the fair value rather, you were told the fair value of the medical cooling system is 22 million naira. Since the fair value is 22 million, fair value is 22 million naira. Remember, I told you to always go for the lower of the two. So this is lower, is smaller than this. This is the lower. The present value is the lower. So we will go for the present value. If present value is chosen, that means the fair value of 22 million will not be relevant. Working number 2. Calculation of finance charge. Calculation of total finance charge. I've told you that finance charge is the same as lease interest. Lease interest. We want to calculate the total lease interest. So we have total lease installments. We have 6 installments. The medical cooling system for a 6-year term. So the installment is 6 at the rate of 4.85 million. 6 installments, and each of the installment is 4.85 million, 4,850,000. So that means the total installment 4 times 4,850,000. Sorry, 6 times 4,850,000. That is 29,100,000. Then from this you less the lower of present value of the minimum lease payment or fair value. And we said the present value is lower than the fair value. No, the fair value is 22 million. So we go for the present value, which is 19,938,350. If you subtract this from 29.1 million, so we have total finance charge that is total lease interest of 9,161,650. And I've told you that this finance charge will be spread over the lease period. So I've given you three methods of spreading this finance charge. The first method is straight line method, and the second method is sum of the digits method, while the third method is actuarial method. I told you of the three methods, the simplest is straight line method. And where the examiner is silent as to the method to use in spreading or in apportioning the finance charge, I advise the use of straight line method. So for our purpose now, since the examiner is not being particular as to the method to use in spreading the finance charge, I will go for straight line method. So annual finance charge now, that is the interest that will be recognized each year, will be 9,161,650 divided by 6 installments. Divided by 6. So we have 1,526,941.67. Let me just say 942. If you put 941.67, you are correct. 1,526,942 approximately to nearest whole number. Now we've gotten the annual finance charge. Then the other thing that will require calculation, working number 3, is the annual depreciation. The depreciation that will be expensed in the statement of profit or loss. So annual depreciation. Since there are no other costs to be added to the present value of the minimum lease payments to get the lease asset, that means the present value of the minimum lease payment will be taken to be the lease asset. So the lease asset, which is 19,938,350 divided by 6 installments, you want to get the depreciation that will be charged annually. 19,938,350 divided by 6. That is 3,323,058.33. So 058 to nearest whole number. Back to the requirement. We have to prepare the journal entries in the books of the lessor and the lessee at the inception of the lease. So I want to start with the journal entries in the book of the lessee, since the double entries I've given to you is the one in the book of the lessee. The one in the book of the lesson will be considered in my next video. So now, what is the name of the lessee? You were to follow the directives of the Ministers of Health to the Medical Research Council to relocate its storage facility to the Federal Capital Territory. The director signed an agreement with Captain Nigeria Limited. Captain Nigeria Limited is the lessor, while Medical Research Council is the lessee. In the ledgers of Medical Research Council, Medical Research Council, MRC. Okay, let me say in the books, this is not a ledger. So in the books of Medical Research Council, so we have journal entries. So in our journal, you have the debit side and the credit side. Debit, credit. Serial number. The first item at the inception of the lease, you debit the lease asset. Let me say debit the lease asset, which is the generator, and the amount involved. So the fair value that will be debited is 19,938,350. 19,938,350. I've told you at the inception of the lease, you will debit the lease asset account with the lower of the present value of the minimum lease payment and the fair value. Then you also debit the finance charge suspense account with the total finance charge. So we want to debit finance charge suspense account, and the total finance charge over the lease term amounted to 9,161,650. 9,161,650. Then you now credit the lease liability account. Lease liability with the total of the two. And the total of the two will represent the total installments. This is the total lease liability, 29.1 million. 29.1 million. Initial recognition of lease assets and liability. Now, 2. This installment, 4.85 million, will be paid. On the payment of the installment, remember, this payment will be made to the lessor. And I told you that the lessor account is the lease liability account. So if you don't want to call it lessor account, you can call it lease liability. So in this case, you debit the lessor because this payment will be made to the lessor. Lessor becomes the receiver. So you debit the receiver, which is the lessor. Then the money is going out of the cash account or the bank account of the lessor, of the lessee rather. You credit the cash book. You credit cash account or the bank account. So you debit the lessor, that is, you debit the lease liability, then you credit cash or bank or cash book. 2, debit lease liability account. The lease liability account or lessor account, credit bank or cash account with the amount paid. The amount paid is 4,000,000 850,000. 4,850,000. So, being the installment paid, being the installment paid. So, that is for that. Number 3. So, recognition of finance charge. So, when you want to recognize the finance charge, you debit the finance charge. No, finance charge is an expense. Debit finance charge account with the finance charge to be recognized for the period, and you credit finance charge suspense account. The finance charge to be recognized for the period amounted to 1,526,942. 1,542,942. Then you credit finance charge suspense. That is recognition of finance charge for the period. Number 4, you will equally need to recognize the depreciation for the period. At the year end, you will also need to recognize depreciation. You debit depreciation expenses and credit accumulated depreciation. The depreciation to be recognized amounted to 3,323,058. 3,323,058. So you credit accumulated depreciation 3,323,058. Recognition of depreciation charge for the year. So this is the journal entries in the book of the Lessee. So my next video, I will examine the journal entries in the book of the lesson. 2. Justify the choice of the lease based on IPSAS 13 leases. Number 2, so the entity should enter into a finance lease. Finance lease. So this type of lease is a finance lease. Reason: the lease term equal the useful economic life. 1. The lease term equal the useful economic life, that is 6 years. Both the lease term and the useful economic life of the asset are 6 years. So that means the lease is a finance lease. 2. The present value of the minimum lease payments exceeds 90% of its fair value. The present value of the minimum lease payments exceeds 90% of its fair value. That is, the present value of the minimum lease payment is close to the fair value. The margin are not too wide. You know the present value of the minimum lease payment amounted to 19,938,350. and the fair value is 22 million. And this is equivalent to 19,938,350 divided by 22 million times 100. So we got approximately equal to 91%. So which exceeded the 90%. So since this is, the margin are not too wide, they are very close. So it's approximately equal its fair value. The present value of the minimum lease payment is approximately equal its fair value. Therefore, the lease involved is a finance lease. So this marks the end of the solution to the question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.